Hello, very good morning to all, and welcome to a brand new week ahead. I hope that you all have a great rest over the weekend. I'm Kelvin Wong here again. Welcome to today's Daily Dose of Market Insights. Today will be Monday, 13th of May, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term technical outlook for today, let's have a quick review what has taken shape on Friday and as well as over the weekend in terms of the cross asset price performance and as well as their respective key events and news flow. So let's start with Friday first. So on Friday itself, we do have a slew of Federal Reserve officials speaking. So let me share my screen. You guys over here. So what we could see over here is that there's this particular Federal Reserve official Bowman. She actually one of the camp together with Bostic that is less dovish. She keep on advocating that the Fed will be on hold with no potential interest rate cuts in 2024. So the big question over here is still inflation. So other than Bowman over here, there's an official called Chicago Federal Reserve President Goolsbee. So Goolsbee also did mention that there's not much evidence that inflation is stuck. That means, i.e., inflation still remains elevated. So overall, right, given the slew of Federal Reserve officials speaking last week, we do have a couple, I think 3 to 4 of them speaking. Bloomberg actually did a summary of them. So overall, if you look at it, there's this slew of Federal Reserve, they actually mentioned to us that they are actually more in favor of higher for longer approach in their interest rate, we call it guidance. That means, i.e., they are still looking for a kind of more data evidence that indicate to them that inflation starts to actually comes down within their 2% target. So overall, they're still looking for potentially keeping interest rate at the current high level for a longer period of time. And in terms of current data also supports their stance. Why? Because if you look at the Friday, the release of the University of Chicago, University of Michigan inflation expectation data. So over here, if you look at the situation, let me, okay, yeah, this is the one. Okay, where is it? It's Friday, down. Yeah, this. So it's a flash Michigan consumer sentiment data for May, and within this Michigan sentiment data is survey based. That means the data compiler, which is the University of Michigan, they actually asked a certain set of respondents in the US to gauge their consumer sentiment behavior and as well as their inflation expectation. So this is more market based rather than market survey based rather than market transacted based on the TIPS, the Treasury Inflation Protection. So this is more survey based. But so survey based result, if you look at the sentiment, it actually went down below expectation and the 6-month lower at 67.4. Right, so market is expecting at 76, so it went below market expectation of 76, 67.4, and also way below 77.2 that was recorded in the previous month of April. And what's interesting over here is that the longer term 5-year inflation expectation based on the survey, which is also inched much higher to 3.1% from 3%, and also the 1-year inflation expectation inched up higher to 3.5%. So that is actually, so all in all, right, we start to see very weak consumer sentiment, but inflation expectation remains sticky on the upside. So if you plot on the trend that I did over here, okay, hopefully I can give you all the trend, the figure of the trend. Where is it? Yes, this is the one. Okay, so you could look at my screen on TradingView. I could plot the trend. So this is the University of Michigan Consumer Center for May, it went down to a 6-month low at 67.4. But however, both the 1-year and the 5-year inflationary expectations start to push up much higher to a 6-month high. And also, if you look at it from a technical analysis perspective, the trend is still inching upwards over here. And it seems to us that the longer term 5-year inflation expectation is doing some kind of major basing formation. And there's this key resistance here at around this 3.4%. If it starts to break out of at 3.4%, it seems to be doing a major bullish breakout. So all in all, right, this set of latest inflationary expectation data, it seems to be supporting that particular group of hawkish, not say hawkish, I'll put it back, less dovish federal officials, less dovish Federal Reserve official monetary policy stances. That means they are in favor of holding the Fed funds rate at this current higher level for a longer period of time. Why? Because inflation expectation is still anchored on the upside rather than coming downwards towards that 2% target, despite the fact that consumer sentiment is coming down. That means, i.e., actually forecasting 3 to 6 months down the road, domestic demand in US tends to be going to be much more lackluster than in on the uptick. So their hands are tied. I mean, yes, they may want to stimulate the economy, but by stimulating the economy, they may push up higher inflationary expectation, which is so not what they want. Right, so it will be like a tug of war going forward, but nevertheless, market is still pretty much dovish. Why? Because if you look at the CME Fed Watch 2, despite that potential stagflation scenario that I highlighted on the University of Michigan data, consumer sentiment coming down, inflation expectation going up, a slew of Federal Reserve officials that are still in favor of keeping rates higher for longer, but the CME Fed Watch 2 is still pointing at least 2 interest rate cuts for before 2024 ends. Okay, by looking at this CME Fed Watch 2, you click on this probability and you go all the way down to this lower part of this table, as you see on my screen over here, cumulative meeting probability. So the current rate is 5.25% to 5.5%. So if you look at it at this situation at this point in time over here, what we have is we have this 26.2% probability that is not showing any signs of coming down, all right, towards 50% probability. So there is still no chance of any, no expect, low odds, I would say low odds of any interest rate cut going in the June and July meeting, and only the first interest rate cut is now being pushed down to the September meeting, which is at a higher chance of 74%. Then thereafter, stamp pad again, at 88 or 89% for the November meeting. Then we have another potential cut in the December meeting, which is standing down to a 62% to bring it down to another 25 basis point to 4.75 to 5% over here. Okay, so this is how you read the table. So at this point in time, market is still rather dovish. Still expecting at least 2 interest rate cut before 2024 ends. So that being said, it actually supported the ongoing bullish tonality in the US stock market on the average. Why? Because on Friday we do have more US indices that is closing up in the green rather than the red. So both the SPX and the Nasdaq 100 closed at 0.17% to 0.26%. The Dow Jones Industrial Average closed at 0.32%, but except for the Russell 2000, which is much more sensitive to inflationary expectation, it down negative 0.67%. Why? Because of the fact that given inflation expectations going up, we start to see a tick up in the US Treasury yield, both on the 2-year and the 10-year. So that also put pressure on the Russell 2000, which is pretty much dependent on the uh, uh, pretty much dependent on the cost of funding. All right, cost of funding over here. Okay, give me a minute. I think my screen is a bit hang for a while just to make sure that everything is okay. Yeah, sorry, I think I'm back right now. I think it should be all right. Yeah, yeah, I think it should be okay. Yeah, I'm trying to, I think the screen should be fine right now. Okay, let me do a check again. Yeah, good. All right. So I think it should be okay. Yeah, it's not frozen. Okay. My apologies, because just now I think there's some technical error. It's maybe frozen a bit. So the Russell 2000, like I explained earlier, why is it bearish? Because it's very sensitive to the US Treasury yield. Because if we start to see an uptick in US Treasury yield, implies higher cost of funding, and the Russell 2000 component stocks are rather very weak in their balance sheet. That means they are pretty much heavily loaded on their debt to run their current business operation. So what we see, increase in debt burden in such company, it will potentially cramp down their net profit margin. So that actually explain that Russell 2000 underperformance on Friday against the other major stock US indices. So talking about that US 10-year Treasury yield, so let's have a quick look at the trend of the US 10-year Treasury yield, since it's rather important. So over here, if we go to the 2-year bond, okay, so you look at 2-year bond, it managed to inch up higher above that 50-day moving average, okay, hit, and it went up, it turned up, and it seems to us that this particular curvature move being supported at the 50-day moving average is also indicating to us there's some signs of bullish momentum coming back into 2-year, and also indicating to us that this medium-term uptrend since the start of 12th of January this year is still pretty much intact. So now what we could see is a confirmation with the break of that 4.94% level, which is the 20-day moving average, that could potentially seize the continuation of that bullish impulsive move on that 2-year Treasury yield inching up to a brand new higher high. Okay, and also what's interesting over here is that 10-year as well, which is the longer term one, managed to actually hold at the 50-day moving average at support right below the key 200-day moving average at 4.32%, and right now it's actually trying to flirt around that 4.5%, but definitely for sure to see a higher chance of a medium term upside momentum coming back into the picture will be a breakup above that 4.6% level. So perhaps potentially for the 10-year, it may just go sideways between 4.6% and 4.32% for now. All right. So as long as being toggle between this sideways range over here, potentially the rest of the other major US stock indices like the Dow Jones, the S&P 500, and the Nasdaq could still continue with their short-term bullish trend that was seen last week and spilling over potentially to this week as well. Okay, so that is the intermarket analysis, and also with the US 10-year Treasury being on support, it also allows the dollar strength to remain on support as well by taking into account of the broad-based dollar index that managed to actually help pretty nicely last Friday, right at the right above the 50-day moving average that's acting as a support at 104.90 level. But as usual, this dollar strength, to see much more prevalent dollar strength, equal to break above the 20-day moving average, which is at 105.70. So that's why for in the short term, yes, we know dollar strength seems to be unsupported, but momentum is lacking. So we do see various dollar major pair is actually trading more of a sideways range configuration in the short term intraday basis. But on a medium term picture, as long as it remains supported by the 200-day moving average, which is at 104.20 for the dollar index, this medium term uptrend on the dollar strength story or narrative, we call it, still remains intact from the low of the 28th of December last year, by taking into account of the technical configuration of this US dollar index that are depicted on the daily chart. All right. So with that, yeah, we know that US 10-year Treasury yield is inching much higher, but given the fact that gold price also remains pretty much firm as well. Why? Because gold itself is a bit strange creature. Why? It takes into account of weak demand as well. So in a state that stagflationary, if that stagflationary demand, stagflationary uh, environment starts to get more and more pronounced as the months goes by, that could also be supported firmer gold prices. Why? Because in a stagflation environment, if interest rate continue to goes up much higher or remains elevated, that could potentially cramp down profit margin. Why? Because eventually domestic demand growth will start to slow down as well. It means, i.e., it could spread up to the rest of the world, given that US is a major economy, and that could also cramp down demand of corporates, services, and products. So eventually, it will be a kind of a risk-off environment. And in such a scenario, the other alternative way to go into it, because bond price will have faced much pressure of coming down, so there will be lesser demand for bonds because of higher interest rate as bond price is inversely related. So the only way market participants may see a safe haven play will be in gold if this stagflation environment starts to play out and get more pronounced as the months goes by down the road. So that actually explains, despite the 10-year US Treasury yield pushing up, the gold price remains resilient on last Friday, and we see that gold price added on another gain of 0.6%, and it broke above the 20-day moving average on last Friday as well. This spot gold XAU/USD. So all in all, what we could see is that the medium term and the major uptrend that is in place since September 2022 still remains intact. That means potentially from a medium term perspective, gold price could continue to see higher high, okay, based on the current technical configuration and how we depict things from a potential stagflationary approach. Then for oil price continue to struggle at the 78.40 key medium-term pivotal support for the West Texas oil. Why? Because of this lack of demand from US, potentially from that weaker consumer sentiment figure. But oil price over here is so pretty much dependent on what OPEC wants to do next on their supply cut, and potentially they could actually extend their current supply cut beyond June this year. But that will come in later part of next month, all right, on that cartel meeting, OPEC Plus meeting. So now with that, right, over the weekend, we also do have a slew of Chinese data. So this Chinese data over here is consumer sentiment, because consumer inflation data and producer price index PPI. Okay, why is this data important? Because that will determine the deflationary risk spiral state in China that the last 1.5 year is being faced due to that persistent weak housing market. So one thing, on the plus side, positive side, the consumer inflation rate actually went much better than expected. So it came in at 0.3% year on year. Market is expecting at 0.1%. All right. So all in all, right, it seems to us that the consumer side of the story, that deflationary risk spiral scenario is not so prevalent. But however, the deflationary risk spiral still intact on the factory gate prices. That means how much potentially this businesses is charging to the end user. So for PPI, producer price index data still continue to inch much lower, negative 2.5% year on year. Yes, even though it went down slightly better than previous month of negative 2.8% for April, for March, but it's still below market expecting of negative 2.3%. So if you look at the trend of the PPI at this point in time, okay, it's a 5-year trend over here. So over here, right, it still continues to hover in the negative territory, okay, since October 2022. Yeah, even though the degree of what I call steepness of decline, year-on-year growth decline, has starts to temper off sideways, but it's still hovering in a negative fashion, neither here nor there. And what's surprising over here is that even on Saturday itself, they do have one data called the, okay, where is it? Oops. Okay, let me go back here. Okay, okay, there's this one. Let me, okay, where's the data? Okay, my apologies. Let me go back again. Okay, I was going to show that another set of data on Saturday. Yes, on Saturday over here. Okay, so money supply growth also went down lower as well, from 8.3% to 7.2%, and below expectation of 8.3% for April. So money supply is taking as something like loan, the the amount of money circulating in the Chinese economy. Okay, so this is I don't have the year-on-year figure because they didn't give me. Okay, so right now, right, the funny thing is economic data here, they don't give me the year-on-year. But let me try to get on. I plot the year-on-year for you on TradingView, not now, maybe tomorrow, due to time constraint. We are able to see that the money supply growth is actually decelerating in the last few months. So what we could see that money supply growth deceleration, inflation PPI, the producer price, the factory gate prices also kind of lackluster, hovering around at the negative 2.5% to 2.2% level, not inching higher, but only a slight improvement in the consumer inflation data. So what we could see over here is that we still do not have a clear sign that the deflationary risk spiral is totally eradicated in China. But however, a bit of consolidation will be on the inflation side, the consumer inflation side of the story, that is trying to actually do a bit of lackluster improvement at this juncture. So that actually should also kind of, in the short term, supports the ongoing positive momentum, bullish animal spirits that is being spilled over to the Hang Seng benchmark indices. All right, so that is about it in terms of the intermarket fundamental, we call it analysis, or linking up the dots that I try to actually explain and decipher for you all. So with that, now let us straight away jump straight into that short-term technical outlook. All right, so the current short-term technical outlook for now, at the moment in time, let us start with the the major benchmark stock indices first. All right, so now let me expand my screen. So let's start with the Hong Kong 33. So on the Hong Kong 33, the price index actually broke above the first support resistance level at around the 19,000 level. Okay, on last Friday, it hit down and rebounded off from this level, now turns into a first pullback support. So with that, I don't want to put it at 18,800 as my short-term pivotal support for today. I'll put it slightly lower, which is at this congestion area here, and also the lower limit of this minor ascending channel that I drew from the low of 1st of May at 18,570. So as long as 18,570 holds, still maintain that short-term bullish bias on the Hong Kong 33, because the short-term uptrend still remains intact. Next resistance to watch out for will be at 19,390, which is close to the upper limit of this minor ascending channel. Above 19,390 exposes the 1.618 Fibo extension at 19,980, which I drew from the low of 22nd of January, and also graphically the 19,080 also confluence with the minor congestion area of 1st of August last year. Okay, only an hourly close below the 18,570 will invalidate this short-term bullish bias on the Hong Kong 33 to potentially kickstart a minor corrective decline to retest 18,250 and potentially the former breakout level of 18,000 slash 17,900. Okay, so that's for the Hong Kong 33, i.e. Hang Seng Index. Nikkei 225, the Japan 225. So last Friday, we were bearish to play that particular range bound scenario within this complex sideways range that the Nikkei 225 is still evolving since the low of 29 of 29, sorry, since 19th of April this year. So what we could see over here, it hit the lower limit at 38,010 before shaping that bullish hammer candlestick at the start of today's Asia session. So with that, we're now hitting the lower limit of this sideways range configuration. So with that, we will now flip back to a bullish bias, and also the hourly hammer starts to also form close to the 20-day moving average, I think as a support as well. So using 38,010 as my short-term pivotal support, flip to a bullish bias, but it's within a range bound environment rather than an uptrend environment, because it's still trapped within a range, and most importantly, it still can't break above that descending trend line that I drew from the high of 22nd of March. So bullish, but within a range configuration, as long as 3810 short-term pivotal support holds. Range resistance to watch out for on the intraday basis for today will be at 38,610 level. Only an hourly close below 3810 will invalidate this bullish bias within a range scenario to see the extension of this corrective decline to expose the next support at 37,680. A break below 37,680 exposes the medium term lower range limit at 37,070 level. Okay, that's for the short term technical outlook on the Japan 225, i.e. Nikkei 225. Now flipping on to the European indices, German 30 DAX. So DAX last Friday, we do have a short term bearish bias for that potential pullback scenario to take shape. Why? Because that push up from the low of 2nd of May seems a bit overextended, and we also with the RSI also exiting from the overbought level as well. But there's no clear sign of a bullish bearish divergence. What I mean by that, price action shape higher high, the RSI also shaping higher high as well. So what we could see over here is that potentially it could be only a minor pullback scenario before that impulsive up move resume. And given the fact that because it's very close to a key short-term pivotal resistance at 18,910, which we highlighted on Friday, so in terms of reward risk ratio, it seems to be pretty much attractive for that potential minor pullback scenario that may unfold within this medium term and short term uptrend scenario that is unfolding in the German 30 or the DAX index. Why? Because price action has really clearly traded above the 20 and the 50-day moving average, and as well as the 20 and the 50-day moving average is concurrently sloping upwards as well. All right, so with that, first support level to watch 18,600 for that potential minor pullback scenario. A break below it exposes maximum 18,470, and around this zone over here we may start to see the continuation of the potential bullish impulsive up move sequence. Okay, however, if we start to see an hourly close above 18,910, that means forget about that minor pullback scenario. What we could see is a very strong continuation impulsive up move sequence within its short term and medium term uptrend phase to expose the next resistance level at 19,030/70, 19,230. So that's for the German 30, i.e. DAX index. Short-term technical outlook on the US Wall Street 30, which is the Dow Jones Industrial Average. Dow Jones Industrial Average is still going to trade sideways over here. So what I could see over here is that the first support area, okay, may come down like last Friday low at 39,360, but I'll not put it so tight over here. I put it at this former kind of range resistance. Breakout turns into a pullback support level at 39,050. So as long as any potential pullback didn't surpass 39,050 level, we will still maintain that short-term bullish outlook on the US Wall Street 30. Next, first resistance to watch 39,775, followed by the all-time high area at 40,020. Only an hourly close below 39,050 will invalidate this direct impulsive up move sequence to actually kickstart a much more pronounced minor corrective pullback scenario to retest the 50-day moving average acting as a support at 38,750. A break below it exposes 38,560, former minor swing high of 24th of April, and also potentially conversing with this 20-day moving average that is coming to act as a support at 38,560 as well. Then on Friday, the Nasdaq 100, we were neutral. And right now it managed to actually break up above close to the upper neutrality range at 18,180 before pullback and stage a bounce right now during the Asia session, holding at the first support level at 18,120. And also where this bounce is at this dotted gray line here. So this dotted gray line is the former descending trend line that I drew from the all-time high area of 21st of March. So with that positive technical configuration that is unfolding in the Nasdaq 100 on the hourly chart, we will be flipping to a bullish bias right now to respect the short-term bullish momentum that is being inflicted or being transformed or transverse into the Nasdaq 100. So with that, I'll be using 17,970 as my short-term pivotal support. I don't put it so tight at 18,120. 17,970 also confluence with the former minor swing low, the minor swing low of last Wednesday, and as well as the 50-day moving average. I think it's a support level as well. 17,970 short-term pivotal support. As long as any potential minor pullback holds above this level, flip to a bullish bias on the Nasdaq 100. Next resistance to watch 18,380, followed by 18,500, which is the all-time high area. Only an hourly close below 17,970 will invalidate that bullish move on the Nasdaq 100 to see another round of choppy corrective decline scenario unfolding. Next with support level that may be exposed 17,810, former minor swing high area of 30th of April. Below it exposes the 20-day moving average acting as a support at 17,680, also confluencing with the this minor range of congestion area here as well. All right, so net overall, if you look at the short-term technical outlook, we do have a bullish momentum coming back into across the board, except for the German DAX, which still has a potential chance of a minor pullback scenario unfolding. Okay, now like I mentioned earlier, the FX market is kind of sideways, but dollar strength being supported. So let us start with the European currency. So the European currency, the euro dollar. So the euro dollar continues to remain below that 200-day moving average and 50-day moving average. That's acting as a resistance, right slightly below our short-term pivotal resistance that we highlighted for the entire of last week at 1.08. So more of a sideways range configuration. As long as 1.08 short-term pivotal resistance holds, potentially the next near-term support level to watch is 1.075. A break below 1.075 exposes last week low at 1.0730. So this was last Thursday low, all right, which is last week low. However, an hourly close above 1.08 invalidate this move to see the continuation of this corrective rebound scenario unfolding. Next resistance to watch will be at 1.085, 1.088 level. Then what's next for the pound dollar, the sterling dollar, or the cable, we call it. Also no change, almost like the euro dollar still trapped below that 200-day moving average, can't go up, and neither it could come down. All right, so still remains that 1.2565 as my short-term pivotal resistance level. So as long as this level didn't surpass, potentially there could be a chance to see a potential kind of a push down within this kind of short-term range configuration like scenario to kind of retest last Thursday or last week swing low at 1.2460, which is pretty key. Why? Because it related to a key event, because despite the fact that the Bank of England turning less dovish, it initially see a sell-off, hit the 1.2460 level that was previously supported since 25th of April, and it can't go down lower, and it just traded up, and thereafter traded sideways below the 1.2565 short-term pivotal resistance. All right, so any form of more pronounced bearishness on the sterling USD or the sterling against the dollar, it got to break below 1.2460 first. All right, so in first step, the first support level to watch will be this minor range support level at 1.2460. However, an hourly close above 1.2565 will invalidate this potential bearish bias within its minor range configuration to see a push up to retest 3rd of May swing high area at 1.2640 next, and above it exposes the next resistance at 1.2710, which is the minor swing high area of 9th of April and 10th of April. Asia Pacific currency, the Aussie dollar. So the Aussie dollar continues to remain weak below the 66.45 short-term pivotal resistance that we have on last Friday. So last Friday we do have that bearish bias. So today Asia session, it hit the first support before rebounding again. So no change, but still maintain this scenario. As long as 66.45 short-term pivotal resistance is surpassed the upside, it may still continues to trade within this kind of sideways range configuration. Only a break below 65.85 may expose the next support level at 65.50, which is confluencing with the 50-day moving average. Only an hourly close above 66.45 will continue this counter trend rebound scenario to extend the next resistance level to come in at 66.80, followed by 67.30, which is the medium term pivotal range resistance of the Aussie dollar. Why? Because 67.30, if you look at the daily chart, is in fact the upper limit of this 67.30 is the upper limit of this symmetrical triangle range configuration that is in place since the low of 13th of October last year. Dollar yen slowly continue to inch higher, so I will still use the 14550 level as my short-term pivotal support level. I don't want to put it so tight at the 20-day moving average at 15516. So 15516 is something like a first support. As long as any potential pullback didn't surpass 15445, we will still maintain that short-term bullish bias on the dollar yen. A break above 1560 exposes the next resistance level, which is a psychological level at 157, and this 157 also confluence with the golden ratio of that 61.8% Fibo retracement of that previous up move from 29th of April all the way down to 3rd of May. All right, so now what's next for the spot go? So for spot go XAU/USD, right now it hit the 2,365 resistance level before shaping that. So what we could see right now is that potentially it may now shape that minor pullback again, given that the RSI has now exited from the overbought level, and potentially the kind of support level on the RSI graphically is around this area over here, okay, around the 37%, and after that will be the oversold zone. So given that it has some bit of room more to go down towards the 37 level, so this minor pullback could continue to unfold. First support level to watch on the minor pullback will be at 2,337, which is the 220-day moving average acting as a support, and below it is 2327, the minor swing high area of 6th of May, and the pullback of this former bullish breakout of the upper limit of the bullish descending wedge, this dotted gray line over here. So with that, right, as long as any potential of this pullback didn't break below 2,327 level, we will still maintain that short-term bullish outlook on spot go XAU/USD. The next resistance to watch out for after last Friday minor swing high area at 2,380 level or 2,378 will be the 2,420 level. Okay, 2,420 level, which is the correspond to the current all-time high area of 12th of April. Okay, so that's for spot go XAU/USD. Only an hourly close below 2,327 will invalidate that last week bullish breakout to see another round of choppy corrective decline scenario to expose the next support area at 2003, which is a psychological level. A breakdown below it exposes the key medium-term pivotal support at 2,265/2,260, which confluence with the upward sloping 50-day moving average as well. Okay, so that's for spot go. So lastly, West Texas crude oil. So like I say, this West Texas crude oil pretty much nasty on last Friday. Tested the 7840 medium-term pivotal support, which is the lower boundary, the lower limit of this medium-term ascending channel that I drew from 13th of December. So give a bit of breathing space here because this is a medium-term pivotal support. So we need to have a kind of a daily close below this level decisively at 7840 before saying that this medium-term uptrend that is in place since the low of 13th of December 2023 is game over. All right, so with that in mind, we will flip to a neutrality stance for today on a short-term intraday basis, neutral between 77.50 and 80.30 level. So 80.30 level was last week or last Friday swing high that it attempt to break, but it can't break, and after it shaped that decline. All right, so also conversing with the 200-day moving average as well. So given this kind of mixed element, neutral between 80.30 and 77.50 on a short-term intraday technical outlook for West Texas oil. Okay, so with that pretty much sum up for that short-term technical outlook for today. So what's next on the calendar for today? Let's take a quick look at the economic calendar over here. So today will be a rather quiet day, other than in the European session, we do not have any much key economic data releases. So except that when we come to the US session, we do have before the start of the US session at 9 p.m. Singapore time, we do have two Federal officials speaking, Fed Jefferson and Fed Mister will be speaking at 9 p.m. Singapore time, and thereafter will be a rather quiet US session next. So tomorrow Asia session, the only key data to look out for will be before the start of a daily dose is Japan PPI data that is out at 7:50 a.m. Singapore time. So with that pretty much sum up for today's daily dose of market insights. So I do wish you all a great day ahead, and we shall speak again tomorrow. Thank you.